GM, good morning. Welcome to the Milk Road Show, the daily crypto show where our insights land cleaner than your white t-shirt after you decided to risk spaghetti for lunch. I'm your host, Jay Hamilton, and today we're joined by Tyler Neville, macro analyst for Corriente Advisors. Corriente Advisors. I hope I got that right. Today, we are talking about a very interesting topic that we don't get enough macro experts on the show, and we're trying to bring more on because macro really has a view of where the financial world is moving, not just crypto, the whole financial world, where money is moving, how it all flows together. And today we're going to talk about, is this the Milken moment for crypto? And if you don't know what the Milken moment is, if you don't know Michael Milken, we're going to talk about him. You probably have heard about him, but basically this is a financial revolution that happened back in the 70s, 80s, and it's kind of repeating itself, but now with crypto and with Bitcoin at the center. And what it's leading to is in November, we saw 4 billion in Bitcoin-backed bonds coming in, being sold, bringing money into crypto infrastructure. And spoiler alert, no surprise, this is big for investors like you. Before we jump in and hear from Tyler, we're just going to take a moment to hear from our sponsors who make this show possible. Meet Odos, the DeFi aggregator that makes your token swap smarter, faster, and a whole lot easier. Tired of trading like it's 2019? Odos finds the best prices for your swaps across 900 liquidity sources and 14 blockchains, so you always get more bang for your crypto buck. Whether you're swapping, setting a limit order, or just avoiding gas fees like the plague, Odos has you covered. It's like having a genius trader in your pocket, minus the coffee addiction. Join 3 million wallets already using Odos to power over 6 billion in monthly trades. Start making smarter swaps today at milkroad.com/Odos. Tyler, welcome back to the Milk Road Show.
It's good to be here. What an intro. I mean, that is just incredible.
Well, thanks, man. I appreciate it. Pumping my tires already.
I would have fumbled that bet.
I mean, Corriente Advisors, I fumbled that one a little bit. But okay, so last time we had you on, we talked about the shift that's happening from decentralization to centralization. And what we're seeing now is a lot of these centralized institutions, these large money funds, these pension funds, these asset managers that are starting to move their capital into crypto, but they're not doing it in the way that the rest of us are doing it, just going out and buying Bitcoin on chain. They're doing it in a very interesting way. And I want to let's start with, can you just explain, maybe give us a little history lesson on Michael Milken and what happened back in the 70s and 80s with junk bonds? And that'll kind of set us up for the rest of this episode.
Sure. Yeah. So generally, bonds back in the day, most were just triple A rated. So like back before, the 70s, you bought Procter and Gamble bonds or GE bonds or, General Motors bonds, and they were always triple A rated. And pensions would only buy triple A rated bonds, meaning they were the cream of the crop. Businesses were sound, and you were higher up in the capital structure, and you just had a yield attached to it. It's kind of like putting your money in a CD, which you never hear about anymore. But what happened in the 70s was this guy, Mike Milken, came along, and he created this new financial product called the junk bond. And he basically gave access. He figured out that there's investors out there that want a little more yield to their bonds and are willing to take a little more risk to buy those bonds. So, he basically started lending to riskier borrowers. So it would be like oil and gas exploration companies, or, he was an early lender to News Corp or, the news industry. And there's several wireless companies started using junk bonds to finance cable companies. So a lot of the infrastructure of the 20th century was built using this product. And so they would just offer a little bit more of a yield to build out their infrastructure. And then, they'd pay that junk bond off similar to any other, AAA rated company. They just got, offered a little bit higher interest rate for it.
Mm-hmm. And let's just take a step back for a second. So what we're talking about is mainly we're talking about corporations issuing bonds. I think a lot of people, when they hear bond, they might think treasury bills, T-bills, and the government issuing bonds. That's not what we're talking about here. We're talking about corporations issuing bonds as a way to raise capital. And even though it's funny when you say junk bonds and things like oil and gas and News Corp, because now those are a lot of those companies are very legitimate and some of our biggest companies. But you have to remember there is a point in time when they weren't so legitimate and they had a tough time raising capital. And so this new what Michael Milken created, this new financial product of junk bonds, which I also find a bit of a misleading term. It makes it sound like they're way worse than they are. Like
Yeah.
they're sure there's risk in them, but it's much less risky than going and investing in equity, right? Like
Yeah, exactly. You're higher up in the capital structure, and you have if all shit hits the fan, you still have a tie to they liquidate the assets, and you get part of that. So that's the whole point of owning a bond in general. But yeah, the junk bonds they rarely default in a good liquidity cycle where the Fed keeps rates low, et cetera, and conditions are healthy. But in a bad cycle, they do default sometimes.
Right, right. And so these large funds, pension funds, are they the way they invest is different than the way that a lot of our listeners invest. A lot of our
Yes.
listeners are investing, they're looking for, I mean, you're laughing because it's so true. Like our listeners are just buying meme coins, looking for large gains. These
Yeah.
are we're talking about maybe actually just explain the mindset, the financial mindset of like a pension fund or one of these big institutions and the way a fixed income investor thinks it through.
Yeah. So say I'm a, blue collar guy, worked at, a Detroit motor plant, and I put money, or the company basically has this pension for when I retire. They do not want to be investing in super risky stuff. They want, basically the most risk averse things where they can make, say 6 to 8% a year. And so bonds fall into that category perfectly, where you can basically invest, hundreds and billions of dollars, hundreds of billions, trillions of dollars in this asset class where you get a yield. And generally, you just get paid that rate of interest, 6 to 8% a year. And then when the bond comes mature in, whatever time frame, 10, 20 years, then you get all that money back. So it's perfect for a pension fund investor or a baby boomer who doesn't want to take much risk. And so therein lies, a lot of the last 30 years of investment is as the boomers were getting older, these pensions need to allocate more and more. And a lot of them are unfunded. So, and if you take a public employee of a state pension, more tax dollars from that state have to go towards the pensions to basically buy more bonds. And so this is the cycle we've been in as these baby boomers have aged, where there's a super demand for bonds and it's mandated. That's why rates are so low, is because this money keeps getting recycled, and it's from state pensions, a lot of it, and because they're unfunded. So that's why this whole thing exists. And generally what happens is rates go down in the bond market, and bonds market spreads go down far enough where you open up the frontier markets, where it's not as safe as, say, a very tried and true business that we all know, like Coca-Cola or JP Morgan. It's you kind of start lending to weird parts of the market, like the space market, or the quantum computing market, or wherever you are, or crypto. So now we're at these frontiers are starting to get access to debt markets.
Mm-hmm. Mm-hmm. And so why is this, and maybe this connects into what we're seeing happened in November, and I mentioned in my intro, was that 4 billion in investing came into crypto in a way, and not in a direct. Explain to us what is happening now with these convertible bonds and why this is sort of the crypto equivalent of the junk bonds that Michael Milken created back in the 80s.
Yes. So one of the things we concentrate on at Corriente is we try to find parts of the market that have access problems, meaning they're blocked out of capital markets in a sense, and people won't invest in them for mandated purposes. And when you have that unlock where the access changes, it usually causes an asymmetric price, movement. And so one of the things that unlocks the price of any asset is the ability to borrow against it. And so if you look at like houses, when you were able to borrow against your house, it actually is like, it's like an ATM. You can use the equity and borrow against it. And then it becomes more liquid and someone else wants to buy that house because those assets are interchangeable, right? And so this is now happening out on the frontiers, like I said, and specifically in the convertible bond market. So what Milken did was he did, fixed rate debt, which was building out the cable and wireless operators, et cetera, oil and gas. Now what's happening is because these giant corporations that everyone knows, they're mega behemoths, they've been so risk averse that the volatility of their stocks are very low and they're very predictable. Like if you take like Apple or Microsoft or whatever, very low volatility in these stocks because everyone kind of knows every piece of information that's going to come out. What's happening in the crypto market is you have high volatility stocks. These things are up and down and up and down and up and down. And this product, the convertible bond, allows you, it's a bond, but with a call option attached to it. So that's why a lot of these companies are getting like really advantageous rates because say 0% or 3% for the convertible bond, you're issuing, it's kind of nuts to think about, but a 0% bond for like say 5 years. And what it is you dilute your stock up 30, 40, 50% from where it's trading now. It's a little bit hard to understand, but instead of just diluting your equity, taking, that 10 shares and making it 20 shares, you're only diluting it at a certain higher price. Mm-hmm. And investors, these bond investors are hoovering it up because in the bond markets, these pensions can only get like 5, 6, 7, 8% on their bonds. And what this allows them to do is they can have this asymmetric return owning a convertible bond because you can actually start, you actually, those bonds, the converts turn into an equity proxy. So you can be up 400, 500, 600% like we've seen in some of these bonds. So this is where, and if you're a pension fund or an endowment or whatever yield investor, an insurance company that needs to pay out insurance claims, that's really interesting to you because that can make the difference of you beating all your competitors, having one bond that's up 400%.
Yeah.
So that's why they're all oversubscribed. So you see like, $4 billion just came to market in the sector and the people can't get enough of them at like really crazy rates. And it's really wacky to see. But what it's allowing is them to get a backdoor access to the industry.
Right. And I just want to go back to this point around the fact that these investors, these large institutions, have very clear mandates. And you previously have worked for some of these institutions in the past. And so just give us an idea, like these mandates are, I'm guessing, pretty strict. Like you can't go you can't do a lot of things. Like you are very restricted on what you do and how, but you have your job is to make sure that you get more yield than at least whatever inflation is at a minimum, and ideally much more than that, correct?
Yeah. I mean, if you look at any prospectus of any of these like mutual funds or ETFs, it's pages and pages long of, nonsense that no one reads, but it's like what you can invest in, what you can't invest in, risk factors, et cetera. And basically a lot of them were written before even Bitcoin existed, but it's so, I mean, it's kind of true, but this allows, like, they can still buy convertible bonds. Certain investors still can buy, fixed rate debt and get access to the industry in another sense, even though, they're not actually buying the Bitcoin, they are buying this proxy that acts similarly to it.
it sort of points out something that I feel like I hadn't really clued into, which was that is it we all talk about, institutional money coming into crypto and how it's not really here yet. And what I'm hearing is that it's not that they don't want to. They
Mhm.
actually maybe do want to. I'm sure there's some that are old school and maybe not that interested, but there's probably actually a lot that do want to, but they just can't. Is
Yes.
that
And
is that accurate?
this this is part of, I mean, if you want to get existential, think about the Elon Musk thing where there's never been regulations that went away. There's only been a up and to the right growth of regulations. And I think it's the same sort of premise where it's really hard to break down some of these gates that have been put up. And that's why it caused the irony of the whole thing is the centralization has basically been had because you put up these gates to these industries, right? As asset management firms, et cetera. So you don't really have competition as BlackRock or T Rowe or Fidelity or whatever, because there's the gates to access are huge, like millions and millions of dollars to do all this stuff now. Back in the day, it was like Joe Schmo could, start a fund with $100,000 and get a track record. And now it's a lot harder. But herein lies the interesting part is now they've put up so many gates that it's really hard for them to invest in the frontiers. So what's happening is the frontier returns are going bonkers. They're going crazy, and they're dying to take.
And
So they
they're
have to go to their boards, and then they have to go to their shareholders, and it's like what we're seeing with Amazon and Microsoft. They're putting it on now. The boards have to address it, and they're getting some pressure now because this thing's $1 trillion plus industry. And so it crosses this Maginot line where you're actually going to be underperforming if you don't invest in it. And, that's sort of this centralization to decentralization. Now they were like, oh, that's nonsense. You don't invest in these frontiers. It's stupid. Like space is stupid, right? Like whatever. You were going to go to Mars. But now it's getting less stupid because if you look at Rocket Labs or Lunar or whatever these companies that are, we don't own them, but you can see now they're getting access to capital, similarly to the crypto industry. So the frontier markets are now working. And I'm talking more macro, not crypto, but it's all the same trade because you have these centralized oligarch type companies, and now the gates are getting pounded on. And so they have to go to their boards and get all the OKs. And theoretically, that opens more access. Like we've saw, you brought up previously, Wisconsin Pension owns it. Mass Mutual, giant insurance company, owns a little Bitcoin. To get through these boards is really hard, but it's happening. And you're seeing it even on a nation state level.
For sure, for sure. I mean, and I think it is just starting. And let's be clear. We're talking mainly when we say like Amazon and Google, we're talking mainly about Bitcoin. Like that is
Yes.
there's whether it's nation states or whether it's corporations or whether
I'm
it's
not
these
all,
large.
yeah,
Yeah, we're not talking about altcoins or Pepe or whatever
yeah.
meme coin of the month. We're talking about Bitcoin, but that's how it all begins. That's how it all starts. Is they get access to Bitcoin, and yeah, it's
Mhm.
fascinating that they want the access, they want to get in, and they've almost created too much regulation and rules that they've left themselves out from these opportunities to get access to these frontier markets, and so they're kind of stuck on the sidelines. But now with convertible bonds, they have an opportunity to get in.
Yeah, I mean, like it's one way to get in. It's like the backdoor way, but they're probably working on knocking on the front door too. Like if you think about it as a career risk standpoint, is you go from I make choices as I'm 50 years old and I'm playing not to lose at 50. Well, you think the mentality, whereas you're 22, you're like, I mean, it's probably everyone watching the show or, early 20s, 30s, you're gunslinging. You're like, you know what? If I lose some dough, I got all my life to make it back. But if you're 55 and you have a big mortgage, you're playing not to lose. Like you don't want to. So that's the mentality in a lot of these big oligarch bureaucratic companies. But eventually the demographic switch, right? Where the up and coming, maybe the younger guy that pushed Bitcoin was like, hey, it's up 5,000%. Hey, old guy, get the hell out of here. And then those demographics naturally come into play, and gold stops being cool, and Bitcoin is the new replacement. You've even seen Federal Reserve Chairman Jay Powell said that recently. It's digital gold. And if it's digital gold and gold is a $10 trillion industry and Bitcoin is a $1 trillion industry, where do you think it's going long term? I mean, there's going to be bumps along the way, and it could cause some geopolitical hiccups, but I think that's basically existentially where we're at in the marketplace right now.
And what this means is that we have these crypto infrastructure companies. I think, Bitcoin mining companies, large infrastructure companies that have a easier way right now in this current moment, and likely my guess is you would say throughout the rest of 2025. I don't know what your time frame is in your mind for this cycle, but
Mhm.
for a period now, they have an easier way to raise capital, which allows them to obviously grow faster and to spend money. And they can do it at, as you said, zero interest or very low interest with this convertible bond mechanism.
Correct. And so that's sort of like if you think about your credit card, it's 19% to borrow against your credit card. These guys are getting like 3% around to issue a convertible bond to, I don't think they get like 5 years of duration for 0%. And think about, okay, if I borrow at say 3% and I go to buy Bitcoin and Bitcoin is exceeding that over a 4 or 5 year period, it's been going up 40% on average. That's a great arbitrage. And so they're basically making a bet on the future and saying, I'll make 37% or whatever the average return of Bitcoin is over those 4 year periods. But then you're getting an incredible deal. In fact, but here's where it gets sticky. Like, I'm not telling everybody to just go out there and lever up and spend their life savings on this. The oil markets can put a dent in interest rates, and it can become harder to borrow. But right now, it's really really easy to borrow because credit spreads are low, and these big investors are looking for yield and really frontier investments.
It's very interesting to realize that in many ways, these big investors that have so much money actually struggle to allocate a lot of this capital. It's not easy. There's not a lot of options.
Well, this is part of the problem is we have, I don't know, Peter Thiel talks about secular stagnation, and he says, the most courageous thing, someone can do is actually start a company. And we've had basically all these regulations have stultified our generations, millennial, Gen Z, to start things. And we're looking at like 100-year-old companies that are just dying. And so a lot of it is just a supply and demand imbalance where, look, they had so much money in these pensions that they were buying Austrian 100-year bonds at like -5% interest rate. It was 0% for Austria to borrow for 100 years. That's how crazy this shit got. I mean, this was a couple of years ago, they issued a 100-year bond. They said, we'll take your money, we will pay you 0%, and we'll give it back to you in 100 years. Countries have fallen in less time than that. And it's on.
And why would anybody invest in that?
Because it's mandated. You put your money in a this is how dumb the system is, but your 401k ends up going into a Vanguard yield international bond fund, and that automatically gets sprayed to the finite amount of countries that are issuing the debt. And therein lies the problem: is the systematic investing. It was supposed to help your average pensioner, and it largely has, because like it's not, not everyone's going to be able to manage their money. Mm-hmm. But you end up having these like externalities where you do really bad things on the margin, like where you end up buying the dumbest stuff. And I think that we're just the more you pressure the system where interest rates, you don't let it find a natural rate on the Federal Reserve side or globally, mm-hmm. because they can't. Like, if they let interest rates be where they should be, the whole system would unwind. So they have to dilute fiat currency and keep interest rates low so that the whole thing goes on. But the release valve is Bitcoin at this point, demographically.
Okay, so let's actually talk about that.
Yes.
And before we do though, I just
Mhm.
want to mention, because I think this is like a really, if if you're listening to this and you study macro, and if you follow Milk Road and subscribe to our newsletter, or maybe you subscribe to Pro, you know how much we believe that macro moves markets and liquidity moves markets in the end. And this is exactly what you're saying, is that we are basically, and we've been in this cycle for since roughly 2008,
Mhm.
when all governments started printing money and trying to control interest rates, and we're kind of stuck in that. And this is what we talked about a little bit on our last episode with you, is
Mhm.
there's really no end in sight to it. I mean, I got to assume it ends at some point and we get back to natural business cycle and natural inflation rates, but it doesn't seem like it's anytime soon.
Well, I, I don't think. See, I used to say this. I'm so bearish. I'm bullish.
Mhm.
Is the boomers are not going to take a 50% ding on their houses now, right? And that's really the decision that the whole system has to make. If they're not going to take 50% of their pension money, like they're going to keep printing, and they would rather have inflation inflated away because the promises are so large that they cannot even remotely, if they were to default on these debts, it would be Armageddon. We'd all be like fighting each other in the streets. So you hope that you hope you can keep oil prices down, you hope you can keep food prices down, so that no one kind of goes into World War III.
Mhm.
And that's, if you see a spike in food prices or oil prices and then interest rates and FX starts being all wonky, all these FX cross rates, get the hell out and put your money in your mattress, because that means that the dollar is going to go to the moon. But like that, that I think they're at the agreement they've made at this point is, I call them volatility controllers, is all the central banks would rather just print money till the cows come home. And that's just going to be the way it is.
Mhm. Okay, and that's a nice lead into, okay, so now enter Bitcoin as
Yes.
as the solution here,
Yeah.
as your money gets printed till the cows come home and gets continually just deflated away. And if you just held cash, you'd be basically screwed long term. So enter Bitcoin, and I think in the conversation that we're having right now, we're seeing that a lot of these institutions, these corps that are issuing these convertible bonds, and then these convertible bonds are being bought up by these pension funds who are now getting a little bit of access to this frontier market, maybe a little bit of opportunity at some bigger gains. But the interesting thing is these corporations are using Bitcoin as collateral for these convertible bonds, correct?
Yeah. Every day that goes by, we're seeing more and more corporations basically adopt the Bitcoin standard. I mean, there's some in Japan now. It's kind of nuts. It's kind of a game of game theory, where here's an existential thought. Back in the day, to save your money, you'd find stores of value, whether it be like art, like really, really original art, or wine, or these other things that, but this is the first asset ever in history where you cannot produce more of it, where you can produce more art, you can produce, and not only that, but demographically, I think the next two generations, they don't really give a shit about like a Monet or like Picasso. I don't think, it's kind of like our parents' generation was like, let's buy some china. Remember those stupid plates they would
Oh
buy and
man, yeah.
pass these down? They're worth nothing now because the next generation has no use for them. And similarly, like if you think about what a store of value really should be, how much money went into these other assets? Like, I mean, gold is a good one. It's always been there, but you can produce more of it. There is more supply. So like this is the first one in history where you really can't. And so the game theory behind it is like, how much debt is in the world relative to Bitcoin? And if people ever said like this con game, I was like, I don't want to own debt when you're devaluing the currencies by 10% a year. you inevitably get led to this thing no matter what. And it makes a lot more sense when you're not American, because the dollar, even to give the dollar credit, it actually has gone up even in the face of all this stuff, because everyone else is, second fiddle to us. So but if you're in wherever, Venezuela, you're like, oh my God, Bitcoin makes so much sense. So, and if, yeah, we could go down 10 rabbit holes there, but I'll stop and see you. Yeah.
Okay, so basically we've got a a sort of a perfect storm of macro trends right now that is leading to a inflow of money coming in to crypto, but not directly pumping our bags, not directly buying these, not directly buying Bitcoin, more so investing in the infrastructure of crypto. And that is going to, obviously, that's what we need, because you need more capital in order to build better companies and build better infrastructure and build better tech. And
Mhm.
that's the position we're in, which should, not only should that obviously long term lead to crypto prices going up, but it also will lead to all of these companies being able to raise capital much quicker right now, at least in the short term, and then grow faster. And really, it's almost like a flywheel effect.
Yes. There's a boom and bust cycle here too, where you
Mm.
always have to be vigilant if the capital markets stop providing that capital. Now, this one's a little bit more interesting because Bitcoin miners are half Bitcoin mining, but they're also providing AI, high performance computing power, to the AI big mega cap tech companies. So it's actually like you're building these two frontiers. Like I said, you're building the wireless industry and the cable industry. Now you're building the AI industry and the Bitcoin mining industry, and they kind of go hand in hand, oddly, because they need this giant access to power and energy. So that these things, like when they built the railroads, you had to like convince somebody this is the frontier. When you built the internet, it's this, you get this story early on where you get these super booms because there's the supply of investment is so small, but then you get these super busts because you get morons that overlever themselves and borrow too much money, and then when the cycle turns they default, and then the price drops. So that's sort of, I think we're still in like the sixth inning, if I'm going to
Mm.
say, of this whole cycle. If credit markets change and interest rates kind of skyrocket, then maybe that's different. But the Fed is adamant that they actually are going to still lower rates. In fact, I think we're pricing in like an 87% chance the Fed's going to lower rates in 2 weeks, which is kind of nuts to think about when the markets.
Which might be, by the time you guys listen to this, that might be a day from now or so, because this episode might come out around the time
Okay.
that that announcement is made. Just so everyone listening isn't thinking that it's coming 2 weeks from then. But
Yeah,
uh,
sorry.
it's
Yeah,
okay. It's okay.
but so, I mean, you could be in this world that this is the entire world. Here's the other thing: the entire world has aging infrastructure, and they need Europe needs $500 billion to rebuild their defense because they're afraid Trump's going to pull away from NATO. The Chinese just came out and said they're going to do massive stimulus. I, I think we're just in a giant liquidity cycle. That could change if there's war, but right now the inflation is low, and you should be, if you're a country, you should be spending all the money you can while interest rates are low, and advantageous borrowing rates are there. So that's, I think we're in the midst of that, but we're at all-time highs, and I still feel a sense of bearishness, which is
Hmm.
kind of odd. And I think it's because you have these, like, a lot of people lever up for the short term, but if you zoom out, you're like, holy crap, this has been an incredible market, and you can see it in the credit spreads. Credit spreads tell the true story of
Hmm. And so for investors,
everything.
what what should they be watching over the next 6 to 12 months to indicate that we are still in this bull market, or that we've hit the ninth inning and game over, get out?
Yeah, I mean, my indicator is if your mother-in-law calls you and asks to invest in Bitcoin, just get out. Or,
But
if
isn't that already happening though? Like to
you
me,
have
that's
a
already happening
Bitcoin,
because of 100K, right? Like 100K, I guess not
yeah,
fully. Like we're
I
not
got a
full
lot of
euphoria yet.
I got a lot of text that was like, "Hey, did I miss it? Did I
Yeah,
miss it
right.
yet?"
Mhm.
And to me, I'm not getting. There was a slow hint where you started having people on Twitter post their P&L and how much money they made. That was a little interim euphoria, and then it has faded away the past like week or two, and which I don't think in back in 2008 it was like when your best friend tells you he has 7 houses and is levering up to buy his eighth house and they're making so much money doing this. When your dumbest friend is making a lot of money, that's when I think you have to get out. But like I don't generally have that vibe right now, which maybe I should. Maybe I'm in an echo chamber, but I think you see like a super euphoria where people are like, never investing in a stock again. Bitcoin is all I want to invest in. Like we might get there at some point. There hasn't even been Trump hasn't even been inaugurated, and there's no like if they have a Bitcoin reserve or that could get wonky. And think about like what other countries buy.
Yeah.
So I think it's worth kind of sticking around to see that. And then if you get the super euphoria after that, but always pay attention. You pay attention if things start getting a little bit iffy on in oil. If oil spikes or if interest rates spike higher, I'll change my tune. But right now it's pretty salubrious.
That's a great word. Wow.
Yeah,
Okay. I think we might have to end the episode on salubrious.
oh,
That's
no, that's how they're gonna remember me.
that's that's, that's incredible. Uh,
Yeah.
okay, final question. Um,
Mhm.
what just because you're talking about the potential of a national reserve in the US, other countries are also talking about. Brazil's already talking about it. Some other countries I think are talking about it, but seems like and if a few do it, especially if the US did it, then it's kind of the game, as you said before, of others just kind of have to follow. Do you think that do you think this is the cycle of that type of money flowing into Bitcoin of corporations and large institutions, or is it just is it are we just still going to touch it in this cycle and it'll still take a few more years till we get there?
That's a $1 trillion question. I mean, I think we're at that point. The last we call it the concentric circles of adoption of the first my boss Mark Hart, he was one of the first hedge fund managers to actually get in Bitcoin in like 2014, 2015. And then, what really kicked off the cycle, the first big boom of institutions was the futures market opened up and then Paul Tudor Jones came out and said he owned some Bitcoin. And that was like, and then Elon said it. And so this cycle is a little bit different where it's $1 trillion asset now, which means you can buy it. A lot of big hedge funds own it. A lot of institutions own it. BlackRock obviously is huge. So what's the next stage? What's the next concentric circle of adoption? We saw El Salvador, the Bhutan owns it. I'm sure all these other countries actually do own it. They're just not like posting it. So I don't know. The logical conclusion to me is like everyone has to own a little bit of this because the risk of not is too much. And so it's just a matter of working through that bureaucratic red tape. So that will be the next concentric circle of adoption. And from there we'll see what happens. But yeah, I think we're probably there now and we'll see what happens in the next 6 months. It could reverse, but it feels like there's demographically a lot of the politicians are moving over. Like Bukele's really interesting from a just 20,000 foot view
Sorry, who's
because
that?
the president of El Salvador, who
Okay.
basically he's a millennial and he studies Plato and how to build a country and how countries really work. And our whole framework for how countries were supposed to work before was like, we offer this is probably getting into too much, but this book, Confessions of an Economic Hitman, where you basically, the U.S. goes in, they're like, well, we'll give you some debt if you get on the dollar, and we'll build your infrastructure country, and then you just, we'll own your assets or the debt, and that's how you get them on the dollar, right? And now you have this model from Bukele where you can have a sovereign country where you have $1 billion of Bitcoin that no one else can touch. And you don't have to own US treasuries. You don't have to own Chinese bonds. You don't have to be anybody else. You don't have to be subservient to anybody else, but this decentralized currency. I think a lot of third world countries will start thinking, I don't want to give up my sovereignty to some giant global, oligarch when I could have this option. Think about the implications of debt then. If you're not recycling that money into these debt, you really have to offer something. So anyway, I'll stop on that. Maybe we can talk about it another time.
Yeah, that might be a next episode. But it makes me think of that's like Argentina is a likely next candidate that could be a next El Salvador. Anyways, we'll cut it off. We'll cut it off here because we could keep going forever. Tyler, absolute pleasure to have you back on the show. You've given us a lot of great lines in this episode that we might have to cut out. I think one of the best ones is just like it is at the point where it is too risky not to own a little bit of it. And if anybody listening in is hanging out with some family members over the holidays or anything like that, that might be the line to tell anybody. If they're asking you, should they get in? Is it too late? It's too risky not to own a little bit.
I'll leave you with this. Every time hit the boomers with this, is like, ask them what the return on treasury bonds was for the past 3 years, and then tell them to go look up the return on Bitcoin for the last 3 years, and tell them is that relative risk reward. Like, you've lost bonds, you've lost on treasury bonds if you're a bond investor, and yet that's where they're all putting their money.
That's where they are.
So who's the moron? I don't know. We'll see.
Who's the moron? All right, everybody, thanks so much for listening in today. I do want to know, everybody listening, because Tyler brought it up earlier this episode, is age is such an interesting thing. And I think everybody listening, when you said to everybody listening to Milk Road is in their 20s, I'll bet you all the 40-year-olds, and there's some 50-year-olds, I know there are.
I'm 40.
Yeah, I'm 39. So there you go. You and I we're in the same category. But I want to know, if you guys want to share how old you guys are, throw it in the comments so we know. We'll have a laugh together. Have a wicked awesome day, everybody. Thanks for listening in.
See ya.
As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.